Hello, dear friends. My name is Clive Thompson. I've been investing money for 50 years in stocks. I've made a lot of mistakes and I've learned a lot of new things. I'm here to teach you some of the lessons I've learned about how to make money in stocks. Today's lesson is a timeless lesson. You can listen to it today, tomorrow, next week, next month, next year, or several years from now. It will still be relevant. You will still be able to learn from it and benefit from what you learn. As many of you will know, I'm normally a long-term investor. I don't go for short-term profits, but I get asked by many people about investing and making money quickly. So I've decided to do this video about make a lot of money quickly. But first I'm going to show you a few books that I have read, because I often get asked by my viewers about how they can learn to be better investors. And one of the ways I learned, and I'm sure you can learn, is by reading the books written about or by the greatest investors in the world. So I'll show you a few things that everybody should think about owning on their bookshelf if they want to learn about investing in equities. So the first one I'm showing you is the classic. Every investor in the world should try and get hold of this one and read it, by Benjamin Graham, The Intelligent Investor. There's another one which is equally good, by Benjamin Graham and David Dodd, called Security Analysis. I recommend that one too. Warren Buffett, we all know, is one of the greatest investors in the world. If you can read about him or read what he's written, you'll do well. Here's a book about him. It's called The Snowball. And another one which I think you might like, called The Warren Buffett Way. And this one perhaps is the best of them all in a certain sense. The Essays of Warren Buffett. Lessons for Investors and Managers. But also some of the other great investors which I've read about or have learned from. There's Peter Lynch, One Up on Wall Street. Here's another one about Peter Lynch, Beating the Street. And Philip Fisher, Common Stocks and Uncommon Profits. Howard Marks, a very famous investor, The Most Important Thing, Illuminated. Annotated by Joel Greenblatt, who is also very famous. This is a nice, easy book for anybody who's beginning in investments. It's called The Little Book That Beats the Market by Joel Greenblatt. So a nice, quick, very short book, easy to read. And perhaps you'll like this one as well. You Can Be a Stock Market Genius by Joel Greenblatt. So, personally, I like to invest like Warren Buffett, like Ben Graham, like Charlie Munger, like Peter Lynch, John Bogle, Philip Fisher, those sort of people. And I will be discussing some of their strategies in a future video, along with some of my own, which are special and not in their books. Now, these types of investors that I just showed you, they're the type of investors who choose durable companies which are likely to grow slowly but surely. Patience is the key to becoming rich. So I buy stocks for the long term, and I aim to make money by buying good companies at great prices. It's called getting rich slowly. Of course, I always like to look for catalysts, and a catalyst is something which could happen or might happen or will happen, which could propel the shares higher and faster in a shorter period of time. So the faster you can get that gain, the better. And therefore I look for a catalyst. But I get a lot of messages in my inbox from people who want to make money quickly, which is not my way. But of course there are ways to do that. And you can find the books by them. There's plenty of famous get rich quick investors. History has seen plenty of these. Those who were successful had books written about them. Those who lost it all faded into obscurity. Perhaps the most famous of the get-rich-quick investors was a man called Jesse Livermore. This is a book about him by Edwin Lefebvre. It's called Reminiscences of a Stock Operator. Now, Jesse Livermore made a fortune many times over. He was made bankrupt several times over. I think his wife left him, and in the end, I think he committed suicide alone and lonely. So you don't always face the best of endings, but he did get to be a multimillionaire several times over. And there's other fast buck investors, people who've made a lot of money quickly. These are people like George Soros. There's a book by him called The Alchemy of Finance. George Soros, you may remember, was the man who broke the Bank of England. He made $1 billion in a day by betting against the British pound. In fact, the British pound was in the European exchange rate mechanism, the ERM, and had to stay within a certain band if it was going to enter the European monetary system. In other words, if the British currency was going to become the euro, and because of the trade deficit, the British pound was struggling to stay in the band, and the UK was spending millions and millions and borrowing from the IMF and everybody to try and keep it in the band. But finally, we had George Soros who bet against it, and in one day the pound collapsed because they raised. I remember they raised the interest rate. I think they raised it first to 12% in the morning, and the afternoon they raised it to 15%, and by the evening they put it back to 12%, all in an effort to try and keep the pound stable within the exchange rate mechanism. But George Soros was betting against it, and he had more firepower than the Bank of England. So at the end of the day, he won the game, and he was betting against the pound. The British pound collapsed, and he made $1 billion. Well done to him. Other people who get rich quickly or have got rich quickly include Carl Icahn. You may know some of these names: T. Boone Pickens, Kurt Kerkorian, and lastly Michael Milken. But perhaps you don't want to emulate him too much. The way he made a lot of money was by selling something called junk bonds. So despite the name junk or junk bonds, somehow everyone believed that they were going to get their money back. But unfortunately for him and for his investors, the bonds were exactly what was written on the tin, i.e. they were junk. So unfortunately for him, he went to jail for 10 years for what's called securities fraud. Oh, yes, and I forgot, he also forgot to pay his taxes, which might have got something to do with his jail sentence. So get rich quick can also mean get rich quick. It can also be get poor quickly. Easy come, easy go. So it's not my way, but I understand why young people want to have a go and try and make it quickly. So I'm going to try and talk about that today. So many young people want to speed up the process. They want to believe that in this modern, high-speed, connected world, you shouldn't have to wait decades to make money. You should be able to get the money now. So there are a number of ways to make money quickly in the stock market. None of them can be described as safe, but some are safer than others, and maybe I should just say less risky than others, but none of them are guaranteed to work all of the time, or any of the time for that matter. Now, when I said making money quickly rather than get rich quick, it's because no matter how much money most people have, they're never going to feel that they're rich enough. So perhaps getting richer is the point, or making some money quickly is the point here. Now, what I'm going to show you is a methodology that anyone can follow. You don't need to be terribly skilled. You just need to have some time on your hands, perhaps a weekend, to do the research. But then if you do it well and it works for you, you might be able to make 5 or 6% in a few days. So if you commit $10,000, you might make 600, not guaranteed, or if you hit 100,000, you might make $6,000 in a few days. Now, I want to stress this is not investment advice for you or for anybody. It's just a little trick I've learned, and it doesn't guarantee you that you will make money. You might lose money, you might lose it all. There's no guarantee here. So not investment advice. Now, and when I said you might make 6% over 10 days or 5 days, it's just an estimate. Could be nothing or negative even. But I think the odds are stacked in your favor with what I'm going to show you. And I'm going to tell you, I think it's more or less a free lunch. So in this video, I'm going to show you all the details and prepare the way for you to do the same thing. Now, 2 weeks ago, I did a video about a change in the index which the VanEck Gold Miners Exchange Traded Fund follows. So all exchange traded funds follow a particular index, and their shares must match what's in that index. In percentage terms. So if the index has got 5% in Nvidia, for example, an exchange traded fund which follows that index must have exactly the same percentage in Nvidia. So exchange traded funds basically represent in a certain way a particular index. So you may have heard of the SPX, which tracks the S&P, or the SPY, SPIDER, the SPY they call it. The SPY, or the SPIDER, tracks the S&P 500, and it will own all 500 stocks in the S&P 500 in exactly the same ratio as they appear in the underlying index. There might be some very minor differences. And the share price will always represent the underlying net asset value of the portfolio, give or take a very, very small percentage for fluctuations. But there are large institutions who deliver shares into the exchange-traded fund or take them out of the exchange-traded fund against cash sometimes multiple times a day, to ensure that the exchange-traded fund always mirrors the value of the underlying investments. So 2 weeks ago, I showed something which was happening, something very important, and this is what you can take advantage of. The index which the VanEck Gold Miners Exchange Traded Fund, ETF, follows was being changed to another index, a completely unrelated index with quite a few different shares in it. Now, I want to stress, when I showed this video 2 weeks ago, I didn't give any investment advice or suggest any particular investment action. I merely showed the fact that the index was being changed from Index A to Index B, and I pointed out that this would ensure or enforce the ETF, the Exchange Traded Fund, to sell some of the investments they had in order to buy some of the investments that are in the new index. So some of you managed to figure out what that could be as an implication, and that's what I'm going to show you in this video. So some of you put 2 and 2 together and managed to figure out what they should do. I didn't tell you to do it, but I've received tens, well, maybe even 50 or more messages from different people thanking me for the money they made. Well, thank you very much for that, but I don't deserve it because I didn't tell you what to do. It's not justified. You figured it out, and I'm very glad that you made a profit. So today I'm going to, for those who didn't figure it out or would like to know how to deal with this, I'm going to go into more detail about how you could have made money and how you might do in a similar situation. Again, no guarantees here and not investment advice. So the technique I'm going to show you today is to do with index rebalancing or change of index. So when I did the video 2 weeks ago, it was about the VanEck Gold Miners Exchange Traded Fund, ETF, Exchange Traded Fund ETF. Now that ETF has got the symbol GDX. So in future, when I refer to GDX, I'm just referring to the same VanEck Gold Miners Exchange Traded Fund, because it's easier to say GDX. That's the stock exchange symbol. So an ETF is a fund which trades on the stock exchange, exchange traded fund, and the fund holds all the shares in a particular index. In this case, the index is now known, the new index, the one that it tracks, is known as the MVGDX, or Market Vectors GDX Index. Previously it was a different index, I forget who it was produced by, but that's irrelevant. So in an ETF, there is an index which is made up of lots of different shares, each with its own weighting in the index. Some of the shares will have a bigger weighting than others inside the index. So that's because it's typically a market cap weighted index. It means the largest companies will represent a bigger proportion of the index than the small companies. So for example, a large company like Barrick Gold or Newmont Mining might represent 7 or 8% of the index, whereas a much smaller company might represent less than 1% of the index. So when you have an ETF, it aims to hold every share in the index and in the same proportion as those shares appear in the index. So in this case, our ETF, referred to as the GDX, and the index it tracks so it's referred to, the index it tracks is now the MVGDX, or the Market Vectors GDX Index. So the important feature of an exchange traded fund is that there's a mechanism whereby units can be subscribed or redeemed by large institutional investors who do it all the time to ensure that the ETF trades at the net asset value without any discount or premium, or almost none at all. So as I mentioned in the video 2 weeks ago, the GDX was having a change of index. It was going from one index to another one. So not only were the weightings of some shares in the new index different from the weightings in the old index, but there were also some shares which were not in the new index. That meant that the GDX Exchange Traded Fund would have to sell the shares which were not in the new index. There were also some shares that are in the new index, but which were not in the old index. So new shares appear in the new index which weren't in the old index. That means the ETF would have to buy those shares so it matches the index. And according to the documentation which I read on the internet, all these transactions were scheduled to take place on September 19th, 2025, about 8 days before I make this video. So in the video I explained that this change of index was coming up, and I explained that it meant that some large purchases and some large sales of gold mining stocks was about to take place, most likely on or around September 19th, 2025. However, I stress I didn't give any advice or guidance as to what people should do about it. So those who did something did that off their own bat, putting two and two together. And many of you did, and went ahead and bought one or more of the stocks which were coming into the index, the new ones, the ones that the GDX would have to buy. So what we're going to do today, as a starter, we're going to see how that would have worked out for those who decided to do something. So in my video, I showed 7 stocks which were coming into the index. Here they are. You can see them on this spreadsheet. Those are the 7 stocks. 1, 2, 3, 4, 5, 6, 7. Just in case you're not watching this, it's Industrial Pinolles Aman Mineral, Fresnillo, UK stock, London Gold, that's not L-O-N-D, that's L-U-N-D-I-N, London Gold, Artemis, A-R-T-E-M-I-S, Gold Inc., PT Bhumi Resources Minerals, TBK, and Seabridge, S-E-A-B-R-I-D-G-E. And I just would like to mention, I did a video saying that I wouldn't buy Seabridge because it's not a gold miner. That doesn't mean to say it's a bad stock. Seabridge has a huge amount of gold in the ground. It's a fantastic stock for those who like to go for an asset play, but it's not currently mining, which didn't meet my requirements. So it wasn't a negative on the stock, it was negative on me saying I don't want to own a non-miner. As and when they start digging up that gold or go into a joint venture, of course I might well be interested, but I'm not at the moment into buying companies which aren't making profits. But down the line, they could be making a lot of profit, so it's not a negative on Seabridge. So Seabridge, as an example, we see that they had the previous GDX, the index that GDX was following, had 0% exposure to all of those 7 companies, and all of those 7 companies were going to be in the new Market Vectors Gold Mining Index. Therefore, they would have to buy, in most cases, in 5 of the cases, hundreds of millions of dollars of those stocks. And some of you drew the conclusion, and you were right, that that might cause the price of the stocks to rise. So let's go and have a look at what actually happened. And I'm going to click here. It's called results on my spreadsheet. So this page is called companies which are new additions to the GDX. And it's the same 7 companies. There were only 7 companies coming into the index. Here they are at the top in orange. The same names I mentioned, London Gold, Fresnillo, Seabridge, and so forth. And what I've got here is the holding before in the GDX, which was in every case 0 or 0%. The planned amount according to the index, the MV GDX index, that is in the index. So for example, if I take London Gold, 1.37% is in the index. And after the change had taken place, after the September the 19th, how much is actually in the GDX? And I see for London Gold, it was 0. It's supposed to be 1.37, and the latest number I could get, which is the day before yesterday, is 1.36%. So on the nail. And if you look down here, each of these stocks, they've got the same amount as is the new index, more or less. So the first one, 2.24, it's got 2.2. Next one, 1.54, got 1.61. And you can see the same thing across the board. So for example, Seabridge, it was supposed to be 0.47, they've got 0.46. But that's just an intraday movement, and probably tomorrow it'll be matched up, and if it's not, they'll do some trades to make it match. So how did it work? So here for each stock going down, I've got the price of the stock daily, starting from the 5th of September through to the 26th of September, which is yesterday, that's Friday, close. And the yellow line across here, which you can see on the 19th of September, is the day the index change was taking place. So that's the day they would have been trading. They might have traded a little bit earlier, they might have traded a little bit later, a day later or half a day later, but ideally they'd be doing all the trades at the close of business on the 19th of September, or possibly at the open of business the next day, the next trading day, which was, there was a weekend, so it was a Friday, so the next trading day would have been Monday morning. So let's see how it actually worked out. And I'm going to scroll up a little bit on these stocks. Now what you can see here I've examined various periods. I've done the gain from the 12th of September to the 24th of September, the gain from 12th, so just the 12th of September, that's about 4 days before, to the 24th of September, which is 3 days afterwards. I've also looked at 12th of September, 26th of September, that's the latest price available, that's on Friday, just yesterday. I've done from the 17th of September, which is 2 days before, to the 24th of September, which is 3 days afterwards, and I've done from the 18th of September, which is the day before, to the 26th, which is today. So various periods just to see what the profits would have been. And if we read across the lines here, starting with this one, you can see the first one, you'd have lost money. The second one, you'd have lost money. That's which just, there's one thing to say about PT Aman, which did lose money if you would have bought it. It's an Indonesian stock, and it's down about, over the period, about 13.3% from if you'd bought it before and sold it afterwards. The reason it's down is the Indonesian government have got a ban on the export of copper, and PT Aman have got an extension until the end of this year where they can export copper, but they're running into difficulties with the negotiations to try and get an extension to be allowed to continue to do that, and the share price on the back of failure to negotiate an extension of their deal has fallen quite heavily. So if they can't export copper, it means they can't sell it at the highest price. They can only sell it at local Indonesian prices, and that's why PT Aman has fallen. Unfortunately, it happened just at the period we're looking at this change in the index. So it was really good for the people who own the stock because they had the bad news, they were selling it, and at the same time, the GDX Exchange Traded Fund was buying it, so it kind of bailed out a lot of people who were looking for a buyer for their stock on the bad news. But let's now look at these stocks and see how they collectively did. So in the left-hand column here, I've got the average return if you'd bought on the 12th of September and held to the 24th or held today, if you bought on the 17th of September and held today, or if you bought on the 18th. So the biggest gain would have come if you'd bought the day before the index change. If you'd bought on the 18th of September and held it to today, you'd have, on average, across the 7 stocks, a gain of 10.23%. Now, I'm hearing that some of you might be saying, well, I would never have bought that Indonesian stock, so what would it have been if I never bought this? So let's just take out that Indonesian stock now and see what it would have been. Bam, there it's gone. You would have made 14% if you had avoided the Indonesian stock, perhaps because you read the news about the copper or something. Of course, it's very important to not leap in blind. If you know there's going to be an index change, you're looking at what you're going to buy and sell, have a look at what else is going on because it might change your view. I'll just put that figure back, so copy that. And we'll put that back there, paste. So you would have, even with that loss, on average, you'd have made 10% over those few days. 18th to 26th, what's that? That's 8 days, isn't it? But maybe there's another question you're asking. What about the stocks which were removed from the index? How did they do? So let's have a look and compare the 7 stocks which were added to the index, how well they did, with the 7 largest stocks which were removed from the index. There were more than 7 removed from the index, but for simplicity and keep it on one spreadsheet, I'm only going to look at the 7 largest removals in terms of money. So here are the 7 largest companies which were removed from the index, largest in terms of trade size. They were Discovery Silver, Vault Minerals, Gold Resources, DPM Metals, G Mining Ventures, Orla Mining, and the Chinese Zhejiang Mining. Now, just one thing to say about Zhejiang Mining, it's probably one to be aware of that if you'd been reading, there's a huge corporate transaction going off where they're spinning off all their foreign gold mining interests into a separate company. And that was happening, I think, literally as we speak. So it will, by now, I think those shares have been the subject of an IPO, which was very, very popular and pushed up the share price of Zhejiang Mining. So even though they were selling a lot of the shares in the company, the ETF was selling, a lot of people were buying the shares because they were very excited by the spin-off. But we're gonna obviously keep that included to be fair in the way I do the maths. So here's the 7 largest sales of shares, and I've got, again, like before, I've got the share price every day for each one of them, from the 5th of September through to the 26th of September, that's Friday. And here I've got the average gain. So if we run our cursor across, if you bought on the 12th of September, if you bought every single one of them across here, even with the ones with the profit, you would have made a loss, collective loss of 0.44%. If you'd bought on the 12th of September and held to today instead of 24th, which is a couple of days after, you would have had a gain of just 2.22%. If you'd bought the day before, 17th of September, the average gain through to the 24th was 1.15%. And if you'd bought on the 18th and held to the 26th, your average gain was 5%. So all of those numbers are much less than the numbers I just scrolled to from the previous. So where previously we're looking at the purchases, the gains were, depending on the period you look at, 5.6, 7.7, 7.3 or 10.2. And that's the companies which were bought, and the companies which were sold. The average gains or loss was loss 0.4, gain 2.2, gain 1.1, or gain 5. So those numbers are a lot less on the stocks which are sold than the stocks which are bought. So in English, in simple English, where the ETF had to buy stocks, the price went up. Where the ETF had to sell stocks, either the price went down, or if it rose, it didn't rise as much as the stocks which were being bought. And I've just done a little, in this section here, a little summary of the difference between the two. So, depending on the period you look at, the difference was positive 6% or positive 5.5% or positive 6.2% roughly, or positive 5.2%. So, in a worst case scenario, if you'd bought all the ones which were being purchased and sold all the ones which were being sold out of the index, you could have come up with a return of more than or equal to 5.2% before your commissions. So not bad, and probably an average return, if you, depending on the date you chose to buy them or sell them, of more than 6% in relative terms. That's buys versus sales. Now, the conclusion is that those stocks, if I go back to the ones which were added to the index, those stocks which were added to the index had a gain of 10%. And those which were removed from the index had a gain of 5%. So the difference is just over 5.5%. So just in case you thought that was a fluke of the calendar, that's why I tried multiple different periods of buying and selling. So I didn't want to pick just one date of to buy and one date to sell. I tried different dates of buy and sell just to see how it would have worked out. But all 4 periods that I chose worked out with net positive relative returns on the buys versus the sells. So in conclusion, there looks to have been, in this case, at least a 5% advantage in buying stocks which were about to enter the index. And as to the best date to buy them, it looks like buying a few days before they enter the index, even up to a week before they enter the index, can generate relative profits of 5%. Now, in fact, let's see how this can benefit you. But I'm just going to, before we do that, there's another question which might come up, and that is, what about stocks where the holding in this index was going to be increased? I thought I'd have a look at that. So what I've done here is I've taken the 7 largest money purchases in the GDX because of the index change, where they had to increase the existing holding. So what I've done is looked at the 7 where they had the largest monetary increase in the holding, and I've got the prices of each one. So let's just give you an illustration. If I take Anglo Gold Ashanti, previously they held 4.34% of the ETF in Anglo Gold Ashanti, but the index, new index, has 4.81% in it. So they'd have to buy roughly 0.5% extra. And actually, I look now, the actual holding is 4.88. So they've gone from $837 million to over, is that a million? Yeah, 800, they've gone from 837 million to over $1 billion in this company, meaning they had to buy stocks. And likewise, take another one. Let's take, for example, Northern Star Resources. Basically, based on the change in the index, which they did have 2.92 in the ETF before the index changed. The new index has 4.45, and they've increased their holding. They currently have 4.52. So their holding's gone from 563 million to 955 million. They had to buy $300 to $400 million worth of the stock. So how do these things affect the prices? Well, let's have a look. Here, I've got the average price over exactly the same periods as previously, and you can see for the most part they were all nice gains, but long and short of it is, depending on the period you held it, you'd have made a gain of between 4.8% through to 10.2% roughly. So not only would money have been made by buying into the stocks which were never in the index, but were now going to be in the new index, money would have also been made by buying into the stocks which where the weighting inside the index was changing to the upside. So that's basically a technique which could have been applied to make a lot of money in a very short period of time if you would have picked exactly the stocks which I identified in my video. And you could have done the maths yourself. But I do stress, if you're doing this, read the rest of the news and the rest of the information about the company, because you might find that there are some companies you don't want to touch, even though the index is buying them. Or you might find that there's some of the companies which you were thinking of buying or selling anyway, and knowing what the index is about to do with that stock might tell you whether to act early before the index change or act later, wait for the index change to take place first, and then act afterwards. So as an example, had you got a stock that you're thinking of selling, and you have done some studies and you find out that the index is going to have to invest $300-400 million in that stock, it's probably worth your while not selling yet and hanging on until after the index has changed and they've bought that stock and pushed up the price, and then you sell. So what can you do to find out when an index is going to change or when an index is going to be rebalanced? So it's important to know that an index will be rebalanced or that it will be changed completely. So the first thing you need to know is how to do this. We've got some great tools in this world where you can do this very quickly. You can go to the website of the index, and there's a number of very, very large index providers, and you might find the information on the website, although I'm going to stress when I found out about the GDX, it was quite difficult to find, but it would be there. But you'll find it more easily if you do a Google search. So you do a Google search for something like ETF index revision, or a Google search for ETF index change. And probably Google will find you the right pages for when this is happening. Might even be better if you try and use an artificial intelligence agent, AI, like ChatGPT. Ask a similar question and you might get a better result. There are other places you could look. So when an ETF is changing the index which it tracks in the USA, they're slightly different in other countries, but you can look that up. on Google, when it changes the index, it must file a supplement or an amendment to its prospectus and to its registration. So in the USA, they use a form called N-1A. That's letter N, then a hyphen, then a number 1, then a letter A. You can search for that on Google too. So they have to file that, and a prospectus supplement also has to be filed on EDGAR. Now, EDGAR is the SEC, the Security and Exchange Commission, the SEC's public database. So if they're changing the index, it has to be filed on EDGAR. You can get Google to search on EDGAR, or you can search yourself on EDGAR for any such changes. It's not very easy, but it can be done. But once you've found the changes, I'm going to tell you what you do next. So once you've found that there's going to be a change of index or a rebalancing of index, the next job is to find out what shares are in the new index and in what percentages, compared with what are currently held by the exchange traded fund, and compare the two. So to find out what the exchange traded fund holds, you can typically go to the web page of the provider and go to the page related to that ETF and look for the word holdings. Usually you'll find it somewhere. It'll have a link, and in general, when you click on holdings, it will download you an Excel spreadsheet with each holding, the number of shares, the ticker symbol, the name of the stock, the ISIN number, the value of the holding, and the percentage it represents in the fund. So if you add up all the percentages, you'll see all those percentages added up come to exactly 100%. But you'll see that each stock has got a different weighting. So you're getting what's in the existing exchange traded fund to start with in an Excel spreadsheet. And then you go to the index provider, which usually is a different firm, and you find out what the composition of the index is. Again, you can use Google to find that if you're not sure, but typically each index provider will publish on their webpage the index and the percentage of each holding in the index. Now, in some cases, you might have to log in. It's free. You don't have to pay anything, but you might have to have an email address and a password. Don't ask me why, and they might want to know some information about you, like what country you live in or something. But in general, if you're used to logging into things and so on, you can get it. And usually, as I say, you don't have to pay for that information. But once you're into the index provider, you do exactly the same thing as you did in the ETF. You look for the holdings or the composition of the index. You can do a search on the web page or on their website. And when you find that, it will also be a spreadsheet which you can download. So you download that spreadsheet, which has got the composition of the index. Then you compare what's in the ETF at the moment with what will be in the ETF in the future, which is what's in the index. And don't forget, they give you a lot of advance notice before they change the index. So you'll have maybe several months, 3 months typically, between the time the announcement takes place and the deadline for when the changes take place. So you've got plenty of time to consider what's there and build your spreadsheet. So you've got the two spreadsheets now, side by side, one with what's in the index and the other one with what is what is in the ETF, and the other one with what is going to be in the ETF based on what's in the index. So just to show you how I did that, we'll go back to the Excel spreadsheet, and the way I did that, it says GDX compares to MVGDX. So in my spreadsheet, the way I did it, I had the column called market value inside the GDX on the 4th of September. That was the day I took the photograph or downloaded the spreadsheet. So these are not the market caps. These are the values inside the GDX ETF. And I also got from the index the new weighting in the market vectors gold mining index, which is this column here. And then I multiplied the total value of the ETF, which is right at the bottom here. Go down to the bottom to show you. So the total value of the ETF is was $19.3 billion. So multiplying that number by the new weighting here, I can get to the new value in the index. So as you can see, that new value is based on the new weighting multiplied by the total of 19 billion. So in the first case, the first company, the new weighting is 1.7%. So what does that mean? It means that my new value will be 327 million. Taking that number away from the amount held gives me the change in value. So here I see, because they had zero, it's going from 0 to 327 million. They'll have to buy 327 million. Taking another one as an example, Barrick Gold. Well, let's take that one. Let's take what should we take? Let's take Anglo Gold Ashanti. So Anglo Gold Ashanti had 837 million, but based on the new weighting, it would have to have 890 million, which would have to buy 53 million of stock. Useful information to know that that trade is probably going to go through, and it did go through, most likely, on the 19th of September, which was the date the index was being changed. So you've found the old list of stocks in the ETF. You've found what the new index is comprised of. You've lined up the two indices side by side, just like I showed you, and you now see the difference between the old holding and the new holding, which tells you how much will be bought and how much will be sold. And then you decide whether you want to trade that in the hope of front running the index change, because you know they're going to buy a lot or they're going to sell a lot. And that's basically the way you would make a lot of money quickly. Won't be much, but you know, if you look at it, 5% over 10 days is pretty good return if you can do it. And it's not guaranteed. So please remember that nothing I've said here is meant to be investment advice. It's just something which you can try if you're minded to spend some time on it. It's not guaranteed to make money. It may not work out. It may not work out the way you expect. You can lose money if you get it wrong. You can lose money if you get it right. Don't forget, we're talking about a relative performance. So the minute you buy stocks, you're in the market, and the market can surprise. You know, there might be a crash between the day you buy the stocks and the day you come out of them. So even though, relatively speaking, you might have done better than the stock market, which crashed, you still lost money because of the crash. You know, perhaps a meteorite hits the planet Earth and wipes out a big city, or who knows what. Something bad could happen. On the other hand, we might have a melt-up between the 2 days you buy, and you might get an excessive gain on top of the arbitrage gain. There's a question, of course, when you buy, because you won't be the only one buying and selling. There are some specialist arbitrage funds and hedge funds who specialize in this type of activity. They scan the websites looking for changes, and they will buy ahead. But the question is, how far ahead do they buy? They don't want to buy a month or 3 months ahead, because then they're exposed to the market. And if they're a hedge fund or a market neutral fund, the idea is not to be exposed to the market. The idea is to make money out of the opportunity that's been presented. So they won't want to be exposed for too long. So they're likely to buy very, very close to the index change date, and they're likely to sell very quickly after the index change date. And they might even, in many cases, be actually trading with the fund. So they'll buy ahead at a lower price and sell it to the fund at a higher price on the D-Day, sort of to smooth out the price movements. So if you want to have the advantage, you don't want to be after these exchange-traded funds. You want to be before. And since you don't know, and I don't know when the ETF starts to trade. Does it buy a little bit every day in the week before? Or do they buy the day before? We don't know that. But my advice is, well, it's not. Sorry, I'm not giving advice. My suggestion is, if you want to look at this, you probably want to buy ahead of the GDX, or not GDX, ahead of the ETF purchase, and you want to buy ahead of the hedge funds, which are anticipating that. So looking at the way it worked out, probably in the days before, maybe the very day before, you're leaving it to the last minute. Probably that's a bit too late. Now, while I'm on the subject of this, I want to tell you about some videos I've got coming up which will be very interesting for all of you. I've got plenty more videos which I'm going to be doing about how to make money in the stock market, how to invest, different techniques, describing some of the techniques used by the greatest investors in the world, both for the long term and, of course, more videos about making money in the short term. So if you look at, if you subscribe, you'll get to see these videos. I've got a video or two which are coming up, which are going to be absolute blockbusters. One which is coming up in the coming weeks, and I'm preparing it at the moment, is about the coming global currency reset. You may have heard these words, currency reset or global currency reset. When this happens, and it's not been talked about enough, but you may have heard it, what I'm going to do, in this video, I'm going to explain it to you. I'm going to explain to you what is about to happen. It's not imminent, but it's coming at some point without warning when it comes. And if you are prepared for it, you will be able to make money. If you're not prepared for it, you will lose money, almost guaranteed. So while we're talking about the currency reset, you may want to start preparing yourself before my video, start earlier. And in that respect, I have 2 affiliate links below for those who are interested in discussing the purchase of gold. One of my affiliate links is ITM Trading in the USA. It's a very well-established company which has been around for 28 years. ITM Trading are happy to talk to you to see if gold should be part of your portfolio and to discuss in what way you might like to achieve that goal. There's no obligation to purchase, but you're welcome to have a phone call with them. The telephone number is below this video. So you're welcome to ring them up and talk about whether gold should be part of your portfolio or your pension plan. The number's shown below. And you know what you can do if you're nervous about them. How about go? I've just Googled here their name. So let's go. There it is. Bring it up here. ITM Trading. You can Google them, and if you're interested, go and look at the Google reviews. There's here a lot of Google reviews, all 5-star. That's from their customers, and then you can go to their website. But do look at the telephone number in the link below and mention my name if you do choose to do any business with them, or even if you're just having discussions, say that you'd seen this video and you'd like to talk about it. The other one for viewers in the UK and in Europe is called Gold Bullion Partners. So again, they've got a lot of positive 5-star reviews there, all 5-star reviews. So ITM Trading, you can go to their website and see what that looks like. I just click on this link here. That's the ITM website. You've got lots of information. You've got education, gold and silver, how to put it into an IRA, and of course, lots of interesting videos. And if we go to Gold Bullion Partners, again, you can click on the website here, and you'll get lots of information about how to put in your pension plan. That's your SIPP, buying silver, and interesting articles and different things which could be interesting to you. So please think about my affiliate links if you can, and mention my name, and the phone number for both of those companies is below this video. So let's just finish off here. I will be doing some other videos which could be interesting. One will be about Bitcoin. Now that might surprise you all. So I'm not going to tell you what I'm going to tell you about Bitcoin, but it's going to be a discussion about whether Bitcoin is the new gold, or is gold the new Bitcoin. That will be interesting, and I might perhaps reveal who is behind Bitcoin, or maybe I won't, but you'll have to watch and see. I have more videos coming up about precious metals, including silver, platinum, and palladium, and I'll be telling you about where do these fit into the precious metals complex, and should you own them, as well as gold. I think there's no doubt that everybody should have some exposure to gold, but be diversified. Don't put all your eggs in one basket. So, ladies and gentlemen, thank you very much for watching this video. It's been a real pleasure to have you as my guests. I'd also like to say thank you very much for the comments. I've got some lovely comments on the previous videos. It's your nice comments which encourage me to do videos to educate those who are struggling to find what to do with their money. And if you'd like to see the future videos, don't forget to subscribe. So thank you very much, everybody, and I'm looking very much forward to my next video with you, and I'm going to be reading all the comments in the coming days. Bye bye now.